Hello, everyone, and welcome to this week's fundamental overview by HPD Trading. We will discuss major news, both prior and upcoming, and our expectations of price movement in the financial markets. Please note that this is not financial advice, and nor do we speak for financial experts or analysts. This is just our own personal bias. So, with that being said, let's just move on to the major news that are occurring this week. So, as the world knows, Donald Trump's inauguration is occurring on the 20th. So by the time you're even watching this video, this is either already occurred or just occurring. And this is definitely one of the biggest news that we will have this year, even though this year just started. Um, Donald Trump has been very, very vocal about the trade tariffs that he's going to impose on pretty much the majority of G10 countries and even any other minor country. And although it doesn't seem like these tariffs will be imposed straight away, they'll definitely be imposed gradually over maybe each month, every 2 months. Who knows? This is news. This is more news that we will need to get moving forward. We have the United Kingdom's unemployment rate on the 21st, so I believe that's a Tuesday. Um, of course, with the the crazy bearish movement of the United Kingdom due to its high bond yields, making it very difficult for the government to pay back its debt. This news will be very, very dramatic for the United Kingdom. Canada's inflation rate, PPI, and retail sales on the 21st, 22nd, and 23rd. So, this will be obviously give us some more insight on the path that the Bank of Canada is going to take regarding its interest rates. Same thing for the New Zealand. Same thing for the New Zealand on the 21st, and another very big article of news is going to be Japan's interest rate decision on the 24th, so on the Friday. So we'll discuss that further on, and then of course manufacturing services PMI for the odd, the Australian dollar, the Japanese yen, the euro, the Great British pound, and the dollar, just all across the board throughout this week. So before we even move on to the charts, I want to bring your attention to an article on Forex Live by Giuseppe Della Mota. I hope I'm not butchering his name, but pretty much at the beginning of last week, the Fed were expected to cut rates by 24 base points by the end of the year, and with the news that came out regarding PPI and retail sales, the both of them rose less than expected. By the end of the week, the Fed are actually expected to cut more times. So maybe it will went from one cut to two, around maybe two 25-point cuts. Especially the 42 is a very awkward number. Normally, the central banks cut by 25 points, by 50 points, sometimes even by 15. It really depends on the economic situation, really. So yeah, the Fed are now expected to cut more, and if we have a look at the charts, we can see that this drawdown area, this around 4 days of drawdown, was really due to the disappointing news of the PPI and retail sales. And however, as we can see that due this entire let's say from October 2024 to really now, the dollar has just been appreciating, and HPD do have a very bullish stance on the dollar, just because, as we can see, they are one of the central banks that are going to cut the least. Um, with the Swiss National Bank, they only have 40 points to cut because that's all they have. Their interest rates are at 0.5, I believe, so we don't have much to cut anyway. And not only is the Fed one of the central banks that's cutting the least, but we're not going to cut anytime soon, really, with 98% probability that there's going to be no change in the upcoming meeting. And with this bullish movement of for the dollar, really just fueled by Donald Trump's view on the economy, and we do believe that with his inauguration and with really him beginning his term, his second term, that the dollar is going to continue to appreciate. Um, Also due to the tariffs that he's going to impose, which is going to be greater for the American economy. So with this drawdown, we're really trying to look for any areas of retracements. Obviously, the golden rule of trading is buy low, sell high. So of course that is the most universal rule. So this is what we're going to aim to do. Um, so of course, any area where price does pull back, it is good a good area to buy the dollar. I wouldn't I wouldn't really look for any sells. I don't think it's a good idea, especially the fact that all the other countries, all the other central banks are looking a lot more dovish. So that is our view for the United States dollar. Also, something else to clarify is that the risk sentiment, once Donald Trump is officially elected for the second time, um, will change. And there's really we use two ways of just of having a look at having a feel of the risk sentiment. Number one is by the VIX. So let me try to find where's the VIX. There's the VIX right there. So really, if it's below 20, it really means it's kind of a risk on. So investors are happy to to have higher risk and put their money more into the markets. And another way that we also can you can also have a look is using the Baby Pips website. So if you go on Baby Pips and go on the tools, and you click on the risk on risk off meter, you get another type of visualization. Oh, sorry, excuse me, my mouse is acting up. You get another visualization of risk on risk off. And normally with risk on, with risk off, currencies like the United States dollar, currencies like the Swiss franc, currencies like the yen, and other type of commodities, gold, they do tend to appreciate as they are considered safe havens. So that's something definitely to point out. We don't know what the in economic environment is going to be once Trump is elected. Trump is really very unpredictable. So it's good to be to have a check of the VIX or this risk on risk off meter before before anyone enters trades. I think it's more wise for that. Moving on to the pound. This week has been extremely bearish, very very bearish, just because of how poorly the United Kingdom's economy is really doing, and as we can see, we can go have a look at the monthly GDP, which came out last week as well. So since the Labour government has been in office around, I don't remember, July, June, I'm not too sure exactly when, but really they've had 2 months of growth in this past 1, 2, 3, 4, 5 months. Well, we can even say 6 months. Out of 6 months, there's only been 2 months of growth. Not very good for the economy, and especially with the high interest rates and the very very record-breaking bond yields. So bond yields are really the interest that the government pays for its debt, which is usually typically higher than the interest rates. As, for example, let's say if the United Kingdom's interest rate is 4.75%, in order for the government to make government bonds more appealing, they tend to sell the debt with higher interest rates, appealing for more investors, just because the interest rates are higher. Why would you invest in the currency for 4.75 when you can invest in the government bonds and get a 5% investment, a 6% investment? So and this is for the 10-year contracts as well. So right now we are seeing the yields go lower, which is great, which is better for the economy. And if we have a look at the weekly updates, start of the week 42 points, and by the end of the week we have 65. So more rate cuts, and with more rate cuts mean a devaluation of the currency, obviously, because that's what interest rates are for. Well, that's one of the purposes that interest rates are for, rather. And yeah, with 82% probability of the rate cut at the upcoming meeting. So I believe that one is in February. Don't remember the exact date, but with the rate cut with more rate cuts being priced in, and the rate cut happening sooner, we do have a bearish bias on the pound. Not much space for retracements. Obviously, you can really look for any. Well, if we have a look at fair value, I guess we can draw. Where is it? There we go. VR tool. There we go. So really, anywhere above this line would be honestly amazing. We really doubt it's gonna go up. It's gonna appreciate that much, And according also to JP Morgan and other like Deutsche Bank, they don't see the depreciation of the pound be permanent. They do believe that this is only like temporary, and something to point out. But for the time being, we uh, I don't see many reasons to buy the pound. For the euro, not so much upcoming news really, apart from obviously being affected by potential trade tariffs. God knows when they're going to happen, but we definitely have a bearish bias for the euro due to just because obviously everything really comes down to the interest rates, guys. Like the divergent, like the rate of interest rates cuts, divergences of them. If for example, one central bank is hiking, the other one is cutting. For example, the Bank of Japan is hiking, the the ECB, the European Central Bank, are cutting. Therefore, with divergence exists. Um, at the start of the week, 85 points. By the end of it, 98. So definitely even more bearish by the end of the week, with a 95% probability of a rate cut at the upcoming meeting. So definitely a bearish bias there. The yen has been appreciating actually since the beginning of December, which is not too strange because it's the seasonal tendency is that the euro does appreciate in the last 4 to 5 weeks and the beginning of the first week of the new year. So not too uncommon. So really, if you are looking to sell the euro, just wait for retracements. I believe there's going to be German economic news as well, major German economic news. So definitely, obviously the manufacturing and services PMI, which will give us a further an indication of how well the economy is doing down the line. So yeah, that's that. Now, as for the Japanese yen, we definitely have seen a lot of appreciation in this in the previous week, majorly coming from Ueda's the Bank of Japan's governor Ueda. Having a bullish comment about acknowledging a potential rate hike in their next meeting, which is next week on the 24th, on the Friday. As we can see from the start of the week, the Bank of Japan was expected to hike by 50 points. Probably I think the only central bank in the G10 actually hiking, while all the other central banks are cutting, providing another divergence there for any potential trades. And definitely by the end of the week, a much greater probability of a rate hike just due to those comments. So yeah, the markets have priced that in. And so if you are looking for a buy in the Japanese yen, definitely look for retracements and areas where prices business has been made, price of auctions or demand zones, and not much to say about that apart from the Japanese national core CPI coming out, manufacturing and services PMI coming out. So just indication of how the economy is going to do. And we'll really need to wait for further comments about the next rate hike after the one happening next week. The Bank of Japan's board members have been very not very transparent on exact dates or even their roadmap. So definitely a lot of speculation there. So we can even see a potential devaluation of the yen in the upcoming weeks. Just really depends on what kind of news follows after that. For Canada, a big week this week. Canada inflation, so both the CPI and PPI data will be revealed, as well as retail sales. So definitely we're going to get a really good indication of how well the Canadian economy is doing. As we can see from the previous week, we've definitely seen a big devaluation of the Canadian dollar, attaining equal highs of November, which is very interesting as it definitely had depreciated. The Canadian economy, let's have a look here. Sorry, excuse me. Inflation rate at 1.9%, so they are doing well. They are, attaining their target. And we definitely have room for further cuts, as we can see here. So the Bank of Canada at the start of the previous week had 41 points to cut, and at the end of it had 58 points, with 81% probability of a rate cut in their upcoming meeting. So definitely more of a bearish bias on the Canadian dollar, and we're going to definitely keep an eye on the news for any updates and for um, the biases to be altered. Throughout 2024, the Australian dollar had been really the currency to buy, really, because of their stance on monetary policy, and how they really held the rates pretty much throughout the entire of last year, and we're still holding rates, but that is going to change very soon. So while the Australian dollar appreciated when all the other central banks were cutting, now when all the other central banks are getting towards the end of their cutting phase, the RBA are really beginning theirs. So have a look at the core inflation. So definitely core inflation is a better indicator to look at than inflation rate, because it doesn't include the the rising prices of energy. So this gives us a more accurate representation of inflation, and it is getting down to their target. So I do believe that they are. I think it was like a 70 something percent chance they're going to cut in February, and we can see here the RBA 61 points they're going to cut by the end of this year, with 62% probability of a rate cut in their next meeting, and 71 points now with a 66%. So definitely a higher chance that they are going to cut February, with even more potential rate cuts. So definitely a bearish bias on the Australian dollar. Maybe not now. Right now, it's definitely prices auctioning. So now is a really good time to actually look for retracements to sell. Or if you're still considering the Australian dollar as strong as a buy, definitely the auction allows for areas of buy positions. So definitely that to check out. Having a look at the New Zealand dollar, we can see a lot of depreciation of the currency, just because even throughout 2024 the RBNZ were holding rates, but then they began to really ferociously cut rates 50 points at a time, and 2025 will not be any different. So if we have a look at the expectations, by the start of the week they are expected to cut 125 points, so that's a lot of rate cuts, guys. And now it has decreased, but still, compared to every other central bank, is very, very high. The RBNZ and the bank of the European Central Bank, versus two of them are both still the major central banks that are going to cut the most this year. So definitely more of a bearish stance on this, and right now the price is auctioning. So I guess business deals are being done. This is definitely a very safe area to buy or sell, and look for retracements, look for bargain prices, expensive prices, and yeah. And finally, looking at the Swiss franc, the Swiss National Bank have been in a very tricky situation. So if we have a look at their inflation rates, we can see that it's very, very low. Like compared to every other major central bank, it is 0.7, 0.6. It's very, 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 very low. But they also don't have much base points to cut. So if they do want to boost the inflation rate, they do need to cut more. But they only have around 0.5, half a point really to cut to really boost the economy. So that's why when we have a look at the market expectations, the S&B, despite having very, very low base points to cut, they still remain one of the most bearish central banks. So definitely inflation, the Swiss franc value has been very sticky. It does appreciate, and the Swiss bank do take measures to intervene and to devalue the currency, as they do not want a very valuable currency at the moment. They want inflation to keep rising, and hence they want the Swiss franc to fall. So with that being said, this concludes our fundamental overview for this week. I hope you guys enjoyed. Please let us know what you guys think. What if you have any questions, please ask us. Please don't hesitate to ask. And we're gonna make a lot more videos on this channel. Definitely more in-depth videos too. So obviously this video was very short. It was quite short and not very in detail, but we do have more detailed videos coming soon. And that being said, thank you very much, guys, and see you in the next one.